Welcome to another insightful video. Today we delve into the world of investments, specifically 10 tips for building a solid investment portfolio. Now you might ask, why is having an investment portfolio so important? Well, imagine going on a long journey without a map, or building a house without a blueprint. Sounds difficult, right? That's exactly what it's like to dive into the world of investments without a solid portfolio. A well-structured investment portfolio is like a compass guiding you through the financial wilderness. It's a collection of investments that align with your financial goals, risk tolerance, and time horizon. It's your roadmap to financial success, ensuring you're on the right path to achieve your objectives, whether it's buying a house, saving for your child's education, or building a nest egg for retirement. But building a solid portfolio isn't a walk in the park. It requires careful planning, strategic decision-making, and a deep understanding of the investment landscape. That's where we come in. In today's video, we're going to equip you with 10 valuable tips to help you build a sturdy, balanced portfolio that can withstand market volatility and deliver promising returns. We'll discuss how to understand your investment goals, the importance of diversifying your investments, and why it's crucial to regularly review your portfolio. We'll delve into understanding risk tolerance, investing in what you know, thinking long-term, avoiding emotional investing, starting early, regularly investing, and seeking professional advice. Each tip is a piece of the puzzle, and when they all fit together, you'll have a robust investment portfolio that works for you. So whether you're a seasoned investor looking to refine your strategy or a beginner just starting your journey, this video is for you. So buckle up as we embark on this journey to financial wisdom. First up on our list is understanding your investment goals. Imagine setting off on a journey without a clear destination in mind. You may have the finest vehicle and the most detailed map, but without a destination, you're simply driving in circles. The same principle applies to investing. Without clear, achievable goals, your investments are merely a collection of assets, lacking direction and purpose. Investment goals serve as your financial compass, guiding your decisions and giving your investments a sense of direction. But how do you define these goals? Well, it's not as complex as you might think. It all starts with understanding what you want to achieve financially. Perhaps you're saving for retirement, planning to buy a house, or funding your child's education. Each of these objectives represents a potential investment goal. However, it's essential to remember that investment goals are not one size fits all. They can vary widely depending on several factors. Your age, for instance, can significantly influence your investment goals. If you're in your early 20s, you may be more inclined towards aggressive growth, while if you're nearing retirement, stability and income generation might be your primary focus. Your income level also plays a crucial role. If you have a high income, you might be able to take on more risk and aim for higher returns. On the other hand, if your income is modest, you might prefer safer, more conservative investments. Risk tolerance is another key determinant. Are you comfortable with the idea of potentially losing some of your investment in exchange for higher returns, or does the mere thought make you nervous? Your answer to this question can help shape your investment goals. Lastly, your broader financial objectives should also guide your investment goals. Are you seeking to build wealth, generate income, or preserve your capital? Each of these objectives requires a different investment strategy, underlining the importance of clear, well-defined goals. Remember, clear goals are the first step to a successful investment journey. So take the time to understand what you want to achieve with your investments. It's not just about making money, it's about making your money work for you towards achieving your financial dreams. Tip number 2 is to diversify your investments. Diversification, a word that echoes through the halls of finance and investment like a mantra. But what does it really mean? Well, at its core, diversification is about spreading your investments across various assets to reduce risk. Think of it like this. Imagine you're a farmer planting a field. If you only plant one type of crop and a disease hits that particular species, your entire harvest is wiped out. But if you plant a variety of crops, the disease may only affect one type, leaving the rest of your field unscathed. The same principle applies to your investment portfolio. In the investment world, the crops are different types of assets: stocks, bonds, real estate, commodities, and so on. Each asset class has its own set of characteristics, including different levels of risk and return. By investing in a mix of these assets, you spread the risk. If one asset doesn't perform well, others may do better, balancing out your overall return. Now, diversification isn't just about having different types of assets, it's also about having a variety within each asset class. Let's take stocks, for instance. You could diversify by investing in companies from different sectors. You might have stocks in technology, healthcare, and consumer goods. This way, if one sector takes a hit, the others could potentially cushion the blow. But remember, while diversification helps mitigate risk, it doesn't eliminate it entirely. It's not a silver bullet, it's more like a seatbelt. It won't prevent a crash, but it can certainly help reduce the damage. It's also worth noting that diversification isn't a set-it-and-forget-it strategy. The market changes, and so should your portfolio. It's important to regularly review and adjust your investments to ensure they align with your financial goals and risk tolerance. So there you have it. Diversification in a nutshell is about not putting all your financial eggs in one basket. It's about spreading the risk and potentially smoothing out your returns over time. As the saying goes, don't put all your eggs in one basket. Our third tip is to regularly review your portfolio. Picture this. You've set sail on the vast ocean of investing, your portfolio serving as your trusty vessel. But would you set course and then ignore the compass and maps? Of course not. Just as a sailor must continually check their course, you too must regularly review your investment portfolio. Why is this so important? Because the world of investing is dynamic. Market conditions change, new opportunities arise, and sometimes investments don't perform as expected. Regular reviews allow you to keep your finger on the pulse of your portfolio's performance and make necessary adjustments. Think of it as a health checkup for your investments. You wouldn't ignore a persisting cough, would you? Similarly, you shouldn't ignore underperforming assets in your portfolio. A regular review helps you identify these and decide whether it's time to let them go. Now you may wonder, how often should I review my portfolio? Well, there's no one-size-fits-all answer. It depends on several factors, including your investment goals, risk tolerance, and the types of investments in your portfolio. However, a good rule of thumb is to review your portfolio at least once a quarter. This allows you to track progress towards your goals and adjust your strategy if necessary. But remember, while regular reviews are essential, it doesn't mean you should react to every market fluctuation. Investing is a long-term game. There will be ups and downs, so resist the urge to overhaul your portfolio with every market dip or peak. Instead, focus on maintaining a well-balanced, diversified portfolio that aligns with your long-term goals. Lastly, don't hesitate to seek professional advice during these reviews. Financial advisors can provide valuable insights and help you make informed decisions. After all, two heads are better than one, especially when navigating the complex world of investing. So keep your compass handy and your maps up to date. Regularly reviewing your portfolio isn't just about tracking performance, it's about ensuring your investment journey stays on course. A well-monitored portfolio is a well-performing portfolio. Tip number 4, understand your risk tolerance. Now, what is risk tolerance, you might wonder? Simply put, risk tolerance is the degree of uncertainty an investor is willing to endure in their quest for investment return. It's the level of risk you're willing to accept in exchange for the potential of higher returns. Risk tolerance is not a one-size-fits-all concept. It varies from person to person, shaped by factors including age, income, financial goals, and personal disposition. A young investor with a steady income and years to retirement might have a high-risk tolerance, willing to invest in high-risk, high-return assets. On the other hand, a retiree might have a low-risk tolerance, preferring safer investments to preserve their nest egg. Understanding your risk tolerance is crucial because it influences your investment choices. It forms the backbone of your investment strategy, guiding your asset allocation and portfolio diversification. Imagine being a thrill seeker at an amusement park. If you're someone who enjoys the adrenaline rush, you'd probably choose the roller coaster over the merry-go-round. Similarly, if you have a high risk tolerance, you might lean towards investments like stocks, which can offer substantial returns but come with higher volatility. Conversely, if you're someone who prefers a calm and steady ride, you'd likely opt for the merry-go-round. In the investment world, this equates to a lower risk tolerance, and you'd probably prefer investments like bonds, which offer steady but typically lower returns. But remember, it's essential to balance your risk tolerance with your financial goals. If your risk tolerance is high, but your goal is to save for a short-term need, you might want to dial back on risk. Conversely, if your risk tolerance is low, but you're saving for a long-term goal, you might need to accept some level of risk to achieve a higher return. Risk tolerance is a personal and complex matter. It's all about knowing yourself, your financial situation, and your investment goals. It's about understanding the balance between risk and reward and making informed decisions that align with your comfort level. Knowing your risk tolerance helps you make investment decisions that you can sleep with at night. Our fifth tip is to invest in what you know. Now, this might sound like a bit of a cliche, but it's a cliche for a reason. It's a tip that has stood the test of time and one that many successful investors swear by. You see, understanding the businesses or assets you invest in is not just about knowing their names or what they do. It's about delving deeper, understanding their business models, their competitive landscape, their growth prospects, their financial health, and the quality of their management team. When you invest in what you know, you're not just throwing your hard-earned money into the wind, hoping it lands somewhere profitable. You're making a calculated decision based on knowledge and understanding. This knowledge can be your guiding light, helping you navigate the often turbulent waters of investing. Let's say you work in the tech industry and you're intimately familiar with the latest trends, innovations, and the movers and shakers in the field. It would make sense for you to consider investing in tech companies because you have a deep understanding of the sector. You're in a better position to evaluate their potential and make an informed decision. But what if you're a passionate foodie who knows the ins and outs of the restaurant business? Then perhaps investing in a promising restaurant chain or a food delivery service could be a wise move. After all, who better to spot a winning recipe than someone who knows their bouillabaisse from their bisque? When you invest in what you know, you're leveraging your unique knowledge and experience. You're turning your insights into assets, your expertise into equity. But remember, even though you're investing in familiar territory, it's essential to keep learning, stay curious, and remain open to new ideas. So, whether you're a tech whiz, a foodie, or a fashion aficionado, use your unique understanding to your advantage. Start with what you know and then branch out, because the more you learn, the more opportunities you'll discover. Knowledge is power, especially in the world of investing. Tip number 6, think long-term. As we venture further into the realm of investing, we must remember that it's not a sprint, but a marathon. Investments are not just about making quick gains, they're more about the slow and steady accumulation of wealth over time. This brings us to the beauty of compound interest, often referred to as the eighth wonder of the world. When we invest for the long haul, our money has the opportunity to grow exponentially. Here's how it works. Let's say you invest £100. Over time, that investment grows by, say, 10%. Now, you have £110. If you leave that money invested, the next year's growth is calculated not just on your initial £100, but also on the £10 you earned. This compounding effect can lead to significant wealth over time. Long-term investing also allows us to weather market fluctuations. The financial markets are akin to a roller coaster filled with ups and downs. Short-term investors may panic and sell during these dips, potentially losing money. However, those who think long-term understand that these fluctuations are part of the journey. They know that over time, the market has a tendency to rise, and these temporary dips can be moments of opportunity to buy more at a lower price. Furthermore, long-term investing can be less stressful. You're not constantly checking your portfolio, worrying about the daily ups and downs. Instead, you're giving your investments the time they need to mature and grow, secure in the knowledge that you're building a solid foundation for your financial future. So remember, investing is not about getting rich quick. It's about patience, persistence, and the power of compound interest. It's about understanding that the market will have its moments of volatility, but over the long haul, it has historically trended upwards. Patience, they say, is a virtue. In investing, it could also be a wealth builder. Seventh on our list is to avoid emotional investing, the thrill of a soaring stock, the fear of a plunging market, the greed to make a quick buck, or the regret of a missed opportunity. These emotions are all too familiar to investors, but they can be a dangerous guide. Emotional investing is when decisions are driven more by feelings than by facts. It can lead to impulsive actions such as buying high out of greed or selling low out of fear. This can result in significant financial losses and disrupt a well-planned investment strategy. Consider the dot-com bubble of the late 90s, where the euphoria of the new digital age led many to invest heavily in internet startups, only to see their investments plummet when the bubble burst, or the panic selling during the financial crisis of 2008, where those who acted out of fear missed out on the subsequent recovery. The key to avoiding emotional investing is to stick to a rational, well-thought-out investment plan. This should be based on thorough research, careful analysis, and a clear understanding of your financial goals and risk tolerance. It's also important to maintain a long-term perspective. The stock market will have its ups and downs, but over the long run, it has historically trended upwards. Reacting to short-term fluctuations can hinder the potential for long-term growth. Investing isn't about trying to time the market or chasing the latest hot stock. It's about building a diversified portfolio that aligns with your financial objectives and risk profile. Remember, even the most experienced investors can fall prey to their emotions. That's why it's crucial to stay disciplined, keep emotions in check, and make decisions based on logic and sound financial principles. In the end, it's not about how you feel about an investment, it's about how that investment fits into your overall strategy and helps you achieve your financial goals. So let logic guide your investment decisions, not emotions. Tip number 8, start early. It's a phrase we've all heard in many aspects of life, but when it comes to investing, it's a mantra that truly holds weight. Starting your investment journey early in life has a myriad of benefits. It's not just about having more years to accumulate wealth, though that's certainly a significant factor. The real magic lies in the power of compound interest, a concept often dubbed as the eighth wonder of the world. Here's how it works. When you invest money, you earn interest or returns on that sum. But compound interest means you also earn returns on those returns. And this process repeats year after year. So the sooner you start, the more time your money has to grow exponentially. It's like planting a tree. The earlier you plant the seed, the longer it has to grow, branch out, and bear fruit. Starting early also gives you the luxury of time to recover from any potential losses. The world of investments can be unpredictable, and there may be times when the value of your investments takes a hit. But when you're in it for the long haul, you have many more years to ride out the ups and downs and ultimately come out on top. Furthermore, beginning your investment journey early allows you to take on more risk. Generally, younger investors can afford to invest in higher risk, higher return assets because they have more time to recover from any potential losses. This could significantly boost your returns in the long run. And let's not forget the invaluable experience that comes with time. The earlier you start, the more you learn about the intricacies of investing, the markets, and your own risk tolerance. This knowledge is a powerful tool that can guide your investment decisions throughout your life. So, whether you're in your early 20s or late 30s, remember it's never too early to start investing. Every day you wait is a day of potential growth lost. The early bird does indeed get the worm, especially in investing. 9th on our list is to regularly invest. Now, you might be wondering, why is that so important? Well, one of the most effective strategies for growing your wealth is regular investing. It's not about timing the market, it's about time in the market. Regular investing allows you to take advantage of a concept known as dollar cost averaging. By investing a fixed amount on a regular basis, you buy more shares when prices are low and fewer shares when prices are high. Over time, this can reduce the average cost per share of your investments, potentially increasing your overall return. Think of it as a disciplined approach to investing, a way to automate your wealth building. You're not just saving money, you're putting your money to work. It's a simple yet powerful way to build a solid investment portfolio. Remember, consistency is key in the investment world. Make regular investing a habit and watch your wealth grow over time. Our final tip, seek professional advice. The investment world can be a labyrinth, especially for beginners. It's full of twists and turns with a multitude of investment options, each with its own unique set of risks and rewards. To navigate this complex world, it can be immensely beneficial to have a guide, someone who can provide clear direction and support. This is where investment professionals come in. They possess the knowledge, skills, and experience to help you make informed decisions. They can help you understand your risk tolerance, identify investment opportunities that align with your goals, and develop a robust investment strategy. They can also assist in managing your portfolio, ensuring it remains balanced and diversified. Seeking professional advice isn't a sign of weakness or lack of knowledge. Rather, it's a strategic move that can provide you with valuable insights and guidance. Remember, even the most successful investors rely on expert advice. A good advisor can help steer your investment journey in the right direction. There you have it, 10 tips for building a solid investment portfolio. Let's take a moment to recap what we've explored today. First, we discussed the importance of understanding your investment goals. Knowing what you want to achieve is the cornerstone of your investment journey, whether it's saving for retirement, a dream vacation, or a down payment on a house. Next, we delved into the concept of diversification. Spreading your investments across different asset classes can help mitigate risk and potentially enhance returns. Remember, don't put all your eggs in one basket. Our third point emphasized the need to regularly review your portfolio. The financial markets are ever-changing, and your portfolio should be able to adapt to these shifts. Fourth, we highlighted the significance of understanding your risk tolerance. It's crucial to know how much risk you can comfortably take on and still sleep soundly at night. Then we urged you to invest in what you know. Having a solid understanding of your investments can give you the confidence to make informed decisions. Our sixth and seventh tips were all about thinking long-term and starting early. The power of compounding is a formidable tool in an investor's arsenal, and the earlier you start, the better. We also touched on the danger of emotional investing. It's vital to keep a level head and make decisions based on facts, not feelings. Our penultimate tip was about the importance of regular investing. Consistent contributions can help you ride out market volatility and keep you on track to meet your financial goals. Finally, we recommended seeking professional advice. While there's a wealth of information available, a financial advisor can provide personalized guidance tailored to your specific circumstances. Remember, investing is a journey, not a destination. Safe travels on your path to financial freedom.